How can you quickly boost your credit score? Wouldn't you like that? I mean, with better credit, you could pay lower interest rates on your loans, and you could apply for fantastic travel credit cards and get points and use them for discounted stays at hotels and even free flights like I am right now here in the Caribbean. Hi folks, Michael here. I got some free flights, hundreds of dollars back on hotel stays and more, just because I knew how to play the credit card system. But it all starts with building your credit. So in this video, I'm going to discuss 5 targets that 90% of lenders use when assessing your credit score, and how you can maximize your chance of hitting each of these 5 targets so that your score rises super fast. The Fair Isaac Corporation, otherwise known as FICO, is one of several measures of credit worthiness, but it is used by 90% of lenders in the US, and that's why we're going to focus on it in this video. FICO counts payment history towards your score, number 1 target, because it's weighted at 35% of your overall score. So that's payment history. It's very important here to make sure that you pay on time, never miss a payment, or pay as you go. Beyond this first metric, the second target is amounts owed, and FICO values or weighs this at 30%. In terms of amounts owed, it's important that you don't owe too much. Now, we're not saying zero, especially for credit cards. Also, it's important to look at the amounts owed on all the accounts versus the different types of accounts, and also the number of accounts with balances. For instance, in terms of different types, we could think about installment loans. For example, a car. Here we're thinking about the difference between what is currently owed versus what the initial amount was when you first took out that car loan. Beyond installment loans, another type of common loan is the revolving loan, or otherwise you usually see this in the credit card system. So here we're thinking about the credit utilization ratio. So that is taking the amount of credit that you're using and dividing that by the amount of credit that you have available. It could be, for instance, that you have available $10,000 of credit on your credit card, but you're only using $1,000 this particular month. Right now you've used $1,000, so that's only 10%. Here, the lesson would be to avoid unnecessary use of your credit cards and unnecessary borrowing. You want to minimize that credit utilization ratio so that you maximize your chance of hitting the target here and owing less. Not necessarily zero, but certainly not owing too much. Because again, this is the second most important target that FICO looks at. Again, they're weighing it at 30%. And the third target that FICO looks at is the length of credit history. And the importance is about 15% for your score. Here, we're thinking about the length. For instance, the oldest, so don't close those old credit cards, try to keep them alive, because really the longer that you've had credit history, the better. Also, they will look at the youngest, like what is the most recent account, and what is the average age of your accounts. Plus, they will look at the length of time since you used the accounts. So it's, okay to use things occasionally, but you want to avoid suddenly using a card for a big purchase, right? You don't want to shock the credit card companies because they look at it like, well, that was possibly bad planning, or you've hit an emergency, etc. You just don't want to show that. When you're starting out, you're going to be looking at things like a secured credit card. For instance, here you need to post collateral for a line of credit. It could be that you have a credit card, your first credit card, that's secured for $1,000, and you actually have to put up the $1,000 so that you're really just spending your own money, almost like a debit card. Now, it can go a little bit above that. You could be actually given a little extra credit. In that case, the bank or the credit card company is taking on the risk. As you graduate, of course, you get into better credit cards, but when you're starting off, it will usually be a secured card. Now, it could be that you need a co-applicant to help you apply for a card because they're using better credit, so you can basically use their better credit to start you off. And that's if they're willing to do this. And if they're someone really friendly towards you, they may even authorize you to be used on their own credit card. So that's another way of starting. The fourth target that FICO looks is the credit mix or the diversity. Here, FICO is only allocating about 10% of your credit score towards the mix or the diversity in your credit. Again, we could think about differences like credit cards, retail cards, installment loans, financial company accounts, or even mortgages. Now, when looking at inquiries, when you're trying to ask for credit, there's a hard inquiry which will basically last on your credit report for about 2 years, but with FICO, it only lasts 1 year. So it's important here that you do not engage in too many inquiries. Now, one type of loan is the revolving loan. This is flexible. You can think of, for example, your credit cards, retail gas, or even home equity lines of credit or HELOC where you're taking out a line of credit against the equity in the home you live in. Now, for these revolving or flexible accounts, this is the idea that you can pay off just a small amount every month. As long as you hit that minimum balance or minimum amount necessary, you don't have to pay off your credit in full. Of course, you're going to pay interest on the remaining, so it's better if you could pay it off in full, for instance, a credit card, but it's much more flexible. You don't have to pay everything off in full. You can pay as much or as little as you want, subject to a minimum payment every month that you must make a minimum level payment. But of course, you can pay much more than this if you want to knock down and reduce that principal balance. The same with the HELOC. You could be paying just interest only and not really paying off the principal that you borrowed. Up to a certain number of years, usually with the HELOC, it could be 7 years or 10 years. Again, check the company that is offering you the HELOC in the beginning. Another type of loan is the installment loans. Now, these are more fixed. They're not as flexible. These are more rigid. For instance, here we're thinking of mortgages, auto loans, student loans, where it's the same pretty much every month. A final target for FICO is new credit. FICO is weighing this at about 10%. So the lesson here is just not to take out too many too quick. Now, you could go around rate shopping, and this is pretty good, usually within 5 and 45 days. You know, companies are fairly okay. They look at you and they say, well, you're probably shopping around for rates, and that's why you were making these inquiries. With FICO, they give you a 45-day allowance, which is pretty generous. Maybe you're shopping around for different mortgage rates or different HELOC rates, or even looking for different auto loans to see what they're like. So they give you a 45-day window, and within that 45-day window, you can shop around to your heart's content. Now, for instance, Vantage Score, which is a different type of measure of creditworthiness we don't talk about in this video because it's much less common, they're giving you only 14 days. So you can thank FICO for the 45 days and the fact that most lenders, 90%, use FICO for the score. You can also check your credit report via a credit reporting agency or organization, for instance, MyFICO. And with new credit, you're really looking at the age of the most recent account. So another target not necessarily used by FICO is subscribing to this YouTube channel if you're not already a subscriber. It's totally free, and it definitely will not reduce your credit score. 2 extra bonuses for getting this far. First, here's a real big tip to boost your credit quickly. When you look at your credit card statement, for instance, you will notice that there is a due date, but there's also a statement date. The tip here is to pay off in full, if you can, by the statement date. Now, sure, you have to pay by the due date, but you could owe a little extra and be paying interest as long as you pay the minimum balance. But it's ideal if you can pay off in full and just automate it. Make sure it's in your calendar, or just automate it so you're paying off by full on the due date. However, if you also look at the statement date, you can rapidly increase your score. So how this works is, for instance, you might look and find that the due date could be the 2nd of the month, whereas the statement date could be the 9th of the month. So whatever you use your credit card for up to the 9th, let's say, of February, it will then be due on the 2nd, the due date of March. But what if you paid everything off before the 9th of February so that you had a 0 balance? Well, that's going to show that you've got a 0 credit utilization rate. That's going to be really super helpful for targeting that second target, that is the amounts owed, to show that you're not using anything. 0 credit used divided by the amount of credit that you could use. Now, sure, you were using credit in that month and that keeps it alive, right? It's good to actually keep things alive so that you don't lose it, because that's the third target, length of credit history. You don't want to close the oldest account. And how do you keep it open? Well, you keep it open by maybe just buying some chewing gum once a month. This is typical for those old original cards, maybe your first secured card, your first credit card. You don't want to close that. So you can lower the amount owed by basically paying off before the statement date. That means it shows up as 0 that is due, so that second of the next month, you owe 0. Now you can keep using your credit card after the 9th, but make sure that you try to pay it off before the 9th of the following month. So again, it will show 0 balance. And that is a rapid way of increasing your credit, because you're really targeting that second most important target, which is weighed 30%, the amounts owed. Now, another thing to add rocket fuel to your fire of boosting your credit score is checking out annualcreditreport.com. You can go there yearly. Any errors or inconsistencies or incongruities that you find, you can challenge these, and you should. And that way, you won't be in for a surprise when you discover that your neighbor was actually using your credit or something else. So you'll really want to check the annualcreditreport.com yearly. And you can request your reports online at annualcreditreport.com to get free credit reports from each of the 3 major credit reporting agencies. That is Equifax, Experian, and TransUnion. You can do so once every 12 months. Summarizing, your FICO score measures your credit worthiness and is used by about 90% of lenders. Your score is determined by payment history, 35%, amounts owed, 30%, length of credit history, 10%, credit mix, 10%, and new credit, 10%. So, if you found this video beneficial, why not consider becoming a subscriber? It's totally free. Don't make me jump in there. So click the subscribe button below the video. It encouraged me greatly to make more of these free personal finance, investing, education videos. And with that said, I hope you found value in this video. And if you choose to prioritize building your credit score, then I wish you all the best in your journey. And now I'm going to enjoy my final night here and try to fall asleep to the sound of the ocean waves crashing on those volcanic rocks.